Hey everybody, it's Brian Ullman at Ford Financial Group. I'm a financial advisor and one of the managing partners here. And today we're doing a recording of our mid-year outlook. Now, in the past, we've done webinars for these, but we thought it might be easier to record these so you can listen, or record this presentation so you can watch it on your time. And we also are in the middle of our summer webinar series. We actually just completed one today. We're here in the middle of July. And we have another one coming in August, so you're getting some additional viewpoints other than ours and LPL Research's on where we stand right now and what's coming for the second half of the year. You probably don't need a webinar to tell you that it's been a difficult investing year so far. The first 6 months of the year were pretty dismal. In fact, depending on what measure you use, it was the worst first half of a year in 40 or 50 years. Although if you strip away the calendar element of this, the 6 months of a 20% drop that we had in the S&P 500 goes on about every 4 or 5 years. And so it's not as uncommon. What the uncommon part here is that it's gone on in the first 6 months of the year after the market kind of topped out in early January. So kind of in that context, we're going to dig into the mid-year outlook, which has been prepared by LPL Research, one of our research partners, and they help us put together some of the information that we use to craft the portfolios that we use here. If you see something on this presentation that causes you to have a question or you would like to learn more about, you can email us at info@fordfg.com. Or if you already work here at Ford Financial Group with one of the advisors here, I'd really encourage you to just contact your advisor directly and they can answer the questions that you have. So the theme, as you can see, for our outlook, for a mid-year outlook this year, is navigating turbulence. I think the airplane theme is appropriate, seeing as we've needed to buckle up this year, given what's gone on with markets and interest rates and kind of continuing the global pandemic and war in Europe and so on. And it's true, though, that markets rarely give us clear skies. There's always threats to watch for on the horizon. But if we have the right preparation and context and support, we can kind of navigate those difficult things that lie in front of us. And so far, this year hasn't seen a full-blown crisis like 2008 or 2009 or even 2020 for that matter. But the ride has been bumpy. There's no doubt about it. It's been a while since we've been on such a bumpy ride. And we might not be flying into a storm, but there's been plenty of turbulence so far in 2022. And the real question is how businesses and households and central banks are going to steer through this rough air and how the tone will be set for the markets over the second half of the year. So let's dig in and begin with the economy. Because economic growth is likely to downshift in the latter half of 2022. And that really reflects a slowdown in real spending as a consequence of elevated, persistent inflationary pressures. Recession risks are increasing day by day, it feels like. But the base case from LPL Research is still that we're not going to have any recession this year because consumers, and particularly the upper income consumers, can really sustain their spending patterns because of increased income growth, excess savings, and revolving consumer credit. So let's take a look at the forecast because the forecast from LPL Research really shows their belief that the domestic economy is going to continue to actually grow this year. Other than the anomaly of a negative first quarter GDP that we had, and that was really because of kind of this really big import number because we're so feverishly buying stuff post-COVID, LPL really thinks that the economy has sufficient momentum to offset the inflationary pressures that we're experiencing right now. So LPL's base case forecast includes an inflation rate that actually begins to moderate as the supply chain bottlenecks improve. And then we're potentially going to maybe get some closure to the Russian war with Ukraine. And then their most likely scenario is that the economy actually avoids recession, believe it or not. And their forecasted growth surpasses 2% in 2022. And then there's going to be another downshift in 2023 to have forecasted growth below 2% in 2023. So let's look at the economic forecast here. Overall, consumer spending is likely to slow during the second half of this year as the inflation pressures really weigh on consumers and wage growth actually starts to lag inflation. I think these factors in tandem are actually going to erode consumers' real purchasing power. And wages are growing not as fast as inflation. You don't need to be a math major to know that that reduces your purchasing power. However, recent spending activity actually shows a fairly stable consumer. So that's some good news in here. Real consumer spending actually rose 0.7% in April. That's the fourth consecutive monthly increase in real spending before actually it pulled back a little bit in May. The job market is tight, and that supports consumer spending from gains in personal income. But the real cushion here for consumers comes from roughly $3 trillion in excess savings and that was accumulated during the pandemic from a variety of places, whether it's not traveling and spending, stimulus checks, and so on. So to further pad personal spending, consumers will likely tap into consumer credit. And we expect revolving credit demand to actually increase in the second half of the year without actually reaching unsustainable levels, since consumers hold much less debt now relative to previous economic cycles. After the great financial crisis, consumers really started to aggressively deleverage, and overall debt payments as a percentage of disposable income actually declined and remained pretty steady until the emergence of COVID-19. Government pandemic assistance programs, including stimulus and forbearance periods, actually added volatility to consumers' financial obligations. But if consumers can keep relatively low debt levels, I think the consumer can actually successfully navigate a period of rising borrowing costs without actually cutting off their spending. If the supply bottlenecks actually improve, I think what we can expect to see is that firms will begin restocking inventories. Businesses, companies will start restocking inventories, and that supports underlying economic growth. Really, recent reports that we've gotten from the Institute of Supply Management, ISM, show that order backlogs are actually declining for both manufacturing and service sectors. And so as firms have they've had improved access to required inputs, and and we also have the transportation sector kind of recalibrating to what the current environment is. The economy is actually seeing some growth here in the latter half of this year, and that can actually help avert a recession, because these bottlenecks, the supply bottlenecks, and that helps to push prices higher, adds to the inflation problem. And we're starting to see that backlog start to relent and roll over a little bit. Sticking with economic forecasts, inflation rates are actually likely to cool this year. I think we really are going to see inflation begin to roll over, but the cool down period is going to take a long time and slow. It's going to slow, but inflation's still going to stay above the Fed's long-run target of 2%. Then I mentioned the improvements in supply chains have started to impact consumer prices and helping to keep those in check. Consumer price changes that lagged by 4 months are 72% correlated with the New York Fed's global supply chain pressure gauge. So given the improvement in supply chains, inflation pressures are going to start to subside. Now, that doesn't mean it's going to go away entirely, but we should actually see some improvement with the supply chain, and that's going to prices aren't going to come down necessarily, but it's going to slow prices from going up, and overall, that's a good thing. So the question that always gets asked then is, looking at the economy and seeing, what we're looking at right here, and seeing the supply chains improving and inventories and some good signs with the consumer, how does that affect stocks? Well, the answer is that stocks are going to face a number of headwinds in the second half of the year. But the amount of turbulence, sticking with this flying theme, the amount of turbulence is really going to depend on the pace at which inflation falls. I mean, it's hard to see the bull case through the cloud cover right now, the case where stocks are going to go up pretty considerably. And I really think the volatility here is going to persist. But an improved macroeconomic environment might actually set the stage for some higher valuations, further earnings growth, and actually solid gains for stocks over the rest of the year. So we may not get back to break even. It may be a year like 2018 where stocks actually, measured by the S&P 500, for example, maybe don't get back to where they were when they peaked on January 4th. But also I think we might see a movement off of the lows and higher, and where we recoup some of what we are down from a little bit as we get deeper into the second half of the year. So let's take a look at the 2023 stock forecast. So we're looking into next year, and the amount of time that it takes for stocks to return to prior highs is really going to be determined by the path of inflation. LPL Research expects about 1.5 percentage points to come off of core consumer prices by year end. And the latest reading for the Fed's preferred inflation measure, the core PCE, or the Personal Consumption Expenditures Index, that excludes food and energy, was just short of 5%, 4.9%. So lower inflation tends to bring higher valuations, and the market clearly doesn't expect 8% inflation year over year to persist just based on current stock valuations. But whether inflation eventually settles at 2% or 3% or 4% is really going to go a long way towards determining how much higher stock valuations can go from current levels. So first quarter earnings season wasn't exactly pretty, but given the difficult environment, a roughly 10% increase in S&P 500 earnings per share and nearly 14% increase in revenue, those were both solidly above consensus expectations. That actually makes for some pretty good results. Companies were generally able to pass through price increases to limit pressure on profit margins amid higher materials and transportation costs, labor shortages, rising wages, and various other supply chains disruptions, right? So those increasing costs were passed on the consumers, and it really didn't slow the consumers down all that much. So solid first quarter results set corporate America up to potentially grow the S&P 500 earnings per share by about 8% in 2022 to about $225 a share. And that forecast is still about $5 per share below the consensus estimate and is actually pretty conservative on LPL's part. So their forecast for 2023 is $235 per share and a mid-single digit increase over the 2022 forecast and more than $16 below the consensus estimate of over $251 per share. So LPL is really expecting mid to high single digit earnings growth this year and next year that will help support a stock market turnaround really in the months ahead. So with so much uncertainty, it's really a difficult stock market to forecast. We are in limbo right now, waiting on lots of different data points to help us figure out where we're going. And the range of potential outcomes because of that is much wider than it is in most years. And the challenge really comes from predicting how fast inflation is going to come down, which is actually in turn going to determine how much profit margins narrow and how fast earnings can grow. And that's where interest rates eventually land. So the opportunity for a strong second half isn't really hard to see from where we are right now. Earnings growth, higher valuations in combination can be a powerful kind of force here. So LPL's base case expectations calls for a PE of 18 and 19 and a $235 in S&P 500 earnings per share in 2023. That results in a year-end S&P 500 fair value target range of 4,300 to 4,400. And that's a pretty attractive destination from the market's current location. Now, we're not going to go in a straight line, right? The flight path from here to there is probably going to be bumpy. And that wide range, that 4,300 to 4,400, I mean, that's a pretty wide range, and that really reflects the high degree of uncertainty and the possibility of stocks kind of getting rerouted here along the way. But still, I think it's a pretty good estimate and a fair value target for the market. So let's move on to bonds. And, lots of people, if you're watching this and you're a client of ours, you have bonds in your portfolio. And the value proposition for core bonds, which I think generally here we define as the Bloomberg Aggregate Bond Index, which is a lot like the S&P. We say it's the stock market. Oftentimes we're talking about S&P 500. The Bloomberg Aggregate Bond Index is the broad index for bonds. And the value there with bonds is that they provide liquidity and diversification and positive total returns. They help stabilize a portfolio. But unfortunately, this year, none of those things have helped. And, while these what's the word I'm looking for? While these principles or these features of core bonds generally provide that diversification and stabilization, it's not a guarantee that that's going to happen, and that certainly hasn't happened here this year. So like all markets, fixed income investing involves risk and at times negative returns. It happens. But despite the historically poor start for the year that bonds have had, the value proposition for core bonds has actually improved here recently. Investing is a forward-looking exercise, and with the backup in yields that's already taken place this year, I think now it could be as good a time as any to have core bonds in the portfolio as we look forward instead of looking backward. So we're taking a look now at the 2013 bond forecasts. If I've talked with you on the phone or we've met, we've joked before about TINA, which is an investing kind of acronym that's been around here lately that's short for There Is No Alternative. And the TINA trade, or there is no alternative trade, it's been a big reason why diversified asset allocation portfolios have been overly geared toward equities over the past few years. With rates really low, valuations are really high, and the relative attractiveness of equities over fixed income or bonds was undeniable when interest rates were hovering around all-time lows. Now that interest rates have moved a bit higher, the relative attractiveness between stocks and bonds is much more balanced. So for investors unwilling or uninterested in taking on additional equity risks, there are a number of fixed income markets with yields trading above long-term averages. The yield on most fixed income asset classes is hovering around the highest levels we've seen in a decade. And for the Bloomberg Aggregate Index, yields are the highest they've been since 2010, more than a decade. So since starting yield levels are the best predictor of future returns, following the big move higher in yields this year, future returns for bonds looks much more attractive than they have in years. And with interest rates so low over the past few years, the backup in yields could actually be an attractive opportunity for bond or fixed income oriented investors. And while naturally we can't guarantee that interest rates won't go higher, which would make life difficult for bonds, at current yields where they are right now, the risk reward for owning fixed income has actually improved dramatically in our opinion. So let's take a look at the bond forecast here, because since 2000, the correlation between stocks and bonds has generally been negative. That means that as equity prices are falling, bond prices are rising. Although there's been considerable variation with that relationship over a long period of time. And at times, the relationship between stocks and bonds has actually been positive, meaning they both move in the same direction at the same time. So as a result, the historical correlation actually between stocks and bonds is fairly close to zero, meaning it's pretty noisy. Sometimes it's correlated, sometimes it's uncorrelated. So in other words, it's not that uncommon to see equity and bond prices moving lower or higher at the same time, which means correlations are well above zero. Now, with that said, now that interest rates have soared off of the all-time lows set back in August of 2020, there's more of a cushion for bonds to act like a diversifier during equity market drawdowns. And the backup in yields this year has certainly been painful for bond investors. You just need to look at your portfolio if you've got bonds to see that. But the ability for fixed income to act as an equity buffer has actually increased now in our view. And as bond and equity markets both move past the aggressive repricing of Fed rate hikes that have caused both the fixed income and stock markets to sell off this year, and as we grapple with a potential slowdown in economic growth, we really think, and LPL research really thinks, that bonds are likely to provide that safety net for portfolios again as we move through the balance of the year and into 2023. Excuse me. Let's move into policy this year, because we're in a midterm election year, and we can't really ignore the effects of politics affects everything now at this point, and stocks and bonds are no different, and the effects on your portfolios are no different. And midterm elections are often a balancing act for voters. So it historically tilts heavily against the sitting president's party. Since 1900, the president's party has lost House seats in the midterms 87% of the time, averaging 30 seats lost. Now remember, all House seats are up for re-election in the midterms. Now, in the Senate, where only about a third of the seats are up for grabs, the president's party has lost seats 67% of the time, with an average loss of 3 seats. Now, more recently, losses have been more extreme. So with President Obama losing 63 seats, President Trump losing 41. The only president to actually add seats in recent times is George W. Bush, when he was riding that wave of support after 9/11, when Republicans added 8 seats. Now, Democrats would have a difficult path to hold on to their current slim majorities in the House and Senate if they were facing historical trends here. Now, you add in President Biden's low approval rating, which correlates with midterm performance, and weak consumer confidence due to the high inflation that we've been seeing everywhere, including gas prices. And the odds really heavily favor Republicans taking the House. Republicans seem to be moderate favorites in the Senate as we sit here right now in July. But the makeup of seats for the re-election actually favors Democrats, because 21 Republicans are up for re-election in November compared to 14 Democrats. But genuine toss-up seats are even more evenly matched, and Republicans need to only flip 1 seat to become the majority party. Let's take a look, though, about what this means, because the year after midterm elections have historically been pretty strong for stocks. Incredibly, the S&P 500 has been up higher a year after every midterm election since 1950. That's 18 out of 18 years, with the average gain a year later a very solid 14.5% that you can kind of see here in the green on the right-hand side. So if we break it down by presidential party, it actually doesn't show much difference here. It's up 14.8% under Republicans, 14.5% under Democrats. So the key here is that we get past the election question and have it answered so investors and businesses can move on with whatever they're going to be faced with the new Congress going forward after the midterms. So the midterm arrival affects policy outlooks here because markets hate uncertainty. And we know that midterm elections can bring with them a good deal of uncertainty. What could it mean if history repeats and the Republicans take over both the House and the Senate this coming November? Well, one of the best case scenarios under a Democrat president is Republican control of Congress, with the S&P 500 up an average of 16.3% during those years. It's hard for investors to ignore that kind of statistic. Now, what if Democrats hold on to the Senate but lose the House, which is actually the second most likely scenario here? That combination's actually been pretty good for stocks historically as well, with the S&P 500 gaining 13.6% on average during those years. What you can see here is that when we have split control of Congress, or even a split between Republicans in the House or Republicans in Congress and a president in the White House, that division creates some gridlock, but it also means slower rates of change. You don't have a big sweeping change to the left and the right. And while as citizens we might hate gridlock, investors actually prefer it because you don't have big unintended consequences from massive policy changes or anything sneaking up on businesses they can't account for. And so that's where you get, this, when you have split Congress or split Congress for the president, or even split houses of Congress, you get some pretty solid returns out of the S&P 500. So let's kind of pull all of this together. I think really the bottom line here is that ultimately we believe that the best path forward to navigating any environment, whether the skies are clear or stormy, is actually having a thoughtful plan and the right support that you can get to help you meet your destination, whatever bumps you might have along the way. So I would say if you haven't worked on a financial plan here with us yet at Ford Financial Group, give us a call or shoot an email to your financial advisor, because we're not just trying to craft portfolios. We're actually trying to craft a portfolio that works for you, that is the right fit for what your plans are and what your goals are. We've had a bad start to the year. There's no doubt about that. But we've had bad 6-month stretches before, and we've had stretches that look exact or very close to the ones that we've been in here in these last 6 months. And we don't let those bad stretches derail us. And in fact, we've been through periods, whether it's the crash that came from COVID, the great financial crisis of 2008 and 9, or even the tech wreck that went on in the early 2000s. I mean, I hear often going back that those were times that people wish they had stuck with it, had used those opportunities to their advantage, because it would have had improved their returns and improved their prospects for retirement going forward. And so talk with your financial advisor about what's going on. You can see it by this presentation. It's not all doom and gloom. And find out how these kinds of statistics that we went over today maybe fold in with the portfolio that you have now. I'll finish this up by going through some of the important disclosures. I'll remind you that we do not have a crystal ball and cannot predict the future. And even as some of the slides that we went over in here, that we are really kind of at this crossroads, waiting a lot of economic data and financial information to figure out where the world is headed in terms of inflation and interest rates and supply constraints and things like that. So I'll leave it there. If you have questions, email us at info@fordfg. And I look forward to talking to you soon, either on our podcast or in our next webinar. Take care.